Hello and good morning, listeners. Welcome back to Almus Market Mornings, your daily dose of global financial updates. I'm your host, Swaraj Rajagopal, and we have got you covered on everything from currency shifts to pivotal central bank decisions and important speeches. Plus, you'll gain expert analysis on macroeconomic data that's shaping the market narrative right now. Join us for this episode and navigate the markets with confidence. Strong US economic data was released. Q2 GDP met expectations at 3%. Initial jobless claims were lower than anticipated, and durable good orders outperformed forecasts. This indicates a robust economy leading to a modest recovery in the dollar. In China, more stimulus measures are on the horizon. Reports suggest that China will issue $284 billion in sovereign debt as part of a fresh fiscal package aimed at stimulating consumption and helping local governments tackle the debt problems. All this resulting in the yuan trading below the 7 mark against the US dollar. Good morning, JK. With the strong US economic data and China's anticipated stimulus measures, how do you feel these developments impacting global markets?
Yeah, good morning, Swaraj. Yes, I think you have already mentioned about the US data coming better than expected. Yes, the weekly jobless claims have come better than expected for the second week running. Um, so a lot of concerns on the labor market weakening must be again reviewed. On the GDP side, though it was as expected at 3%, there were revisions to the previous numbers of growth, and particularly the GDP for Q1 was revised from 1.4 to 1.6%. The government also revised the national data for first quarter of 2019 till 2024, and these revisions show that economic growth and corporate profits were stronger in 2023 than it was previously estimated. One more point that caught the attention was the gross domestic income, which is also something that analysts look at, was underperforming compared to the GDP, but that has also been revised upwards, narrowing the gap with GDP. Um, so now the average of GDP and GDI has also improved. Now, given the durable goods orders, which represents how the manufacturing sector is doing, was flat, but expectation was for a drop of 3%. So all in all the data yesterday were much better, and this also has come after the consumer confidence data on Wednesday came far better than expected. Now the markets, to some extent, have taken note of these improvements because they have been positioned on the one side. At least the bond market and the gold have reacted, bit more notably. Yields in the 2 year went up to 3.72, having seen a low of 3.65, and the 5 year yield, the 10 year yield also went up by about 6 basis points. The expectation of rate cut in November is now finally balanced between zero point 0.5 and 0.25. So the focus obviously is on the PCE inflation data today, and there are expectations that the headline numbers will be lower. But even if it does come in line with expectation, I think with no new negative factor from the US economy, I think market will be trying to take some profits off the table. And of course, the stock markets are fundamentally well supported because the growth picture is good, and if the inflation also comes lower as expected, that will be support for the risk assets. But it is the dollar that we are focusing on, which normally, on the basis of the data that we have seen yesterday and a couple of days earlier to that as well, should have recovered, but that has not happened. We are still almost quite close to the 100 mark, that divides between the next phase of bear run in the dollar and a consolidation. So I think today's data can have the potential to see a good correction in the dollar, even if it comes in line with the expectations, and that is very much required. And what might be holding up also is some month-end demand for euros, etc., which would have kept the dollar index a little bit on the weaker side. But there are some outliers like Chinese yuan hit 6.97, which is a 16-month low, because in response to the positive measures announced by the government and the monetary policy changes. Yen, again, the expectation of a near-term rate cut a rate hike seems to be much lower now, because there are some political changes that are happening in the leadership in the ruling party. A new leader who is most likely to favor a continuation of easing, or rather, steady policy rather than immediate changes. So that is the market's expectation. Therefore, we will see a hike not before December. That has kept the yen also slightly on the weaker side. So we have seen a divergent reactions in the dollar across the spectrum. Asian currencies, which have seen a substantial rise in the last few months, to mention Malaysian ringgit and Thai baht as some of the big outperformers, also seem to be stabilizing at the lower level. So all in all, dollar should be able to correct itself upward, so long as today's data does not show inflation falling much more than expected. On the Chinese side, yes, after the monetary policy easing and also support for the stock market through stock fund that the government has created, focus is on the fiscal measures, particularly on what they will do to the real estate sector, which has been extremely depressed with no fresh investment for a long time. So I think these golden week holidays that the Chinese will be observing in the next week, probably post that we should be getting more measures from China. Until then, of course, Chinese market is likely to be well supported, which has already rallied 10% from the recent lows that we have seen. As far as the USD rupee is concerned, we saw a test of 83.70, which now I consider as a strong resistance, because earlier that was the support for the rupee. And this was based on strong month-end demand that we have seen also from oil companies. This is also, remember that this was also a quarter end for the market. So there would have been some outflows, but we were hearing offers from the state-run banks at 83.70, and to see whether the rupee can, again keep trading at the weaker end, as even as most other currencies are stronger. I think that is probably not likely, because if you keep the rupee on the weaker side, while dollar index keeps losing and yuan keeps strengthening, I think we'll be inviting imported inflation. And speaking of inflation, of course, the one of the decisions by Saudi to increase their output, and in the face of big output that has been seen from US companies, non-OPEC members, is seen as depressing the oil prices once again. Brent is already trading at 71. And so earlier, OPEC Plus had decided to not postpone their restoration of output in December, but now they've decided that they will restore as originally thought about, and that increases the supply in the market while the demand seems to be on the lower side. So that's a good news for India. Because then your headline inflation continues to be well contained. Also, on the Indian side, one more good news for the market was the government sticking to their borrowing program as announced in the budget. And there's no upward revision to the borrowing that they have announced. So that will also keep the bond market in good place. As it is, we have seen good inflows to the bond market this month. Of the 10 billion total inflow, record inflow that we have received this month, more than half of it is towards the bond market as well. So India is in a good place. There is no reason to think that rupee should be weaker. I think a gradual move towards 83.40 is once again on the cards now that the month-end and quarter-end demand would have been substantially met. But yes, we will probably wait for the inflation cues from the US economy before we make the next move on the dollar. Thank you.
Thank you, JK. And just quickly summarizing, US GDP was as expected, but what's interesting is there were upward revisions to the previous growth numbers. In fact, growth and corporate profits were greater in 2023 than earlier anticipated. So that's a very interesting development. Durable goods were flat, but expectations was for a drop of 3%. Weekly jobless claims coming better than expected, second week running. So all of these are very positive news for the markets and especially the dollar. But as JK mentioned, we do not see much of a demand for dollar as it is a month end, and typically euro is on the bid on month ends because there is a demand for that. USPC will be out today. Even if it's in line with expectations, there may be some profit taking as markets have been positioned one side. So that is another theme which participants can follow. Asian currencies, which have seen a bout of strength in the recent week, also seem to be stabilizing now. So this is another point in favor of a dollar correction on the higher side, which can be expected. USD saw a test of 83.70, which is a strong resistance and a dip post that. But what's good for India is the continuously dipping oil prices, which should, but since we are a large oil consuming country, that's a positive news for us. That's it from us today. Have a very good weekend and tune in on Monday for the latest in the financial markets.